Good afternoon, everyone. Maria Sanchez-Keen here from the Center for Organizational Effectiveness here at Session 8, Financial Accountability. Thank you for joining us today. We will start with an understanding of what it is that we're going to be covering today. So 1 hour to cover financial accountability. Our hope today is that we will be able to give you some tools again for you to really have in your toolkit related to finances. As you can imagine, as with every topic, there's not enough time, but we hope that this will be helpful to you as we go forward. So the topics we're going to cover, financial terms and language, organizational financial statements, project budgets, operating budgets, and tips and tricks. So why money? Why is it important for us to be thinking about this? I know I've spoken to a lot of leaders who are a little bit intimidated when it comes to finances. Some people talk about it as, I never did well in school when it came to financial stuff. And so they feel a little bit at a disadvantage when it comes to financials. And what we want to do today is give you some of the tools that you might need to feel a bit more confident about finances. And why it's important for you to have an understanding, at least a working knowledge of financial literacy, is because as a not-for-profit, charitable, or public organization, you are responsible for people's money. So whether you're a leader now or whether you will be one in the future, it's your responsibility to understand and ensure that the resources that your organization has are well spent and are well used. And that is whether they are taxpayer dollars or fundraised dollars. Most people have provided them to you in trust, and it's important for you to know how this works so that you can be responsible as a leader for them. So we thought, as we have in the past, just quick things of we'll use interactive polls as we often do. Feel free to also you're muted now, but raise your hand if you want to speak. Use the question box to comment. Kathleen is with us again, and she'll be following that as we go along. So to start, as we do every time, I'll ask you to look at that. My slides aren't up? Oh, this is awful. Thank you. Sorry. That's no good. I thought they were. Ugh, there we go. Thank you, Carrie. Sorry about that. So here we are in the question box that you've missed a few slides, but nothing major. What we're going to do is use our polls. So if you go to Poll EV, again, what you need to do is go under handouts. So if your handouts are over here, under links to poll, you click on it, it opens up the PDF, and it looks like this, and then you'll be able to click right on that, and it should take you then to this whole aspect of financial lingo, which is where we want you to go. So in the poll, click on the link, and I will try to get out of my slides if I can. Second. The first question that you'll see up is, what is the definition of income statement? So this is fun. So if you don't know the definition, write one up. What we'll do is we'll wait for your definitions, good ones. And again, if you don't know, just put something up for us to have some fun with. And we'll see if you like a certain definition, please like it. And we're just going to get different terminology and see what you know. Yikes, yeah. What is the definition of income statement? Where is revenue coming from? That is definitely a part of it. Total amount earned. How much money are you bringing in? I'm guessing, but I suspect that it speaks to what an organization's income is. A confirmation of how much, what we got to spend. Includes revenue and expenses, absolutely. How much money is being made, taxes deducted? Outside of my pay scale, yes. A document outlining all financial information. This will include revenue coming in and purchases being made. Yeah, lots of good guesses. Confirm how much you make in a salary in a year, total amount earned. Yeah. So an income statement, we're going to go through the definitions in a moment, but it's one of those terms. We try to select terms that you might hear regularly, and yeah, maybe outside of your pay scale now, but important for you to have an understanding. How does an income statement work? What does it include? give you a definition in a moment. So here's the next one. All right, so what is the definition of a balance sheet? So these are two important financial terms, income statement and now balance sheet, that most of us as leaders should have just a working knowledge of what it means. So what's the definition of balance sheet? Yeah, I don't know. Good for you. Just put it out there. Yes, assets and liabilities equal each other. Yeah, it has expenses, income, and what the balance of these is. So it is about assets and liabilities. Record of all debt and credits, yep. Income versus expenditures, that's an element of it. The way that you demonstrate your revenues and the costs expended, assets and liabilities, good, yeah. Summary of financial assets and liabilities in a specific period of time, very good. Okay, so we've got a good understanding of what a balance sheet is for some people. And again, if you're thinking, again, I don't know, this is the idea, is to give you working knowledge of some of these important definitions of what they mean. Yep, no idea, that's okay. Yeah, what's coming in and what's coming out. So it's a bit more than that, and we'll talk about that in a moment, what these actually mean. So let's keep working on it and see what else we come up with. So third important definition, this one might be easier for you. What is the definition of a debt? I should say debt or debit, I can't remember. Let me work on it. Definition of a debit. Not debt, but debit. Yeah, money owed. So it's debit, not debt. Money earned, unsure. How much you owed. Transaction made, yeah. Money paid out, yeah. What you owe and haven't paid yet. Yeah, so helpful. Money going out. Left-hand side of an accounting entry, yes. Very good. For some of us, go back to our grade 10. It's like, what did we learn then? Yeah. Okay. So debit. And then the next one is, what is the definition of credit? Thoughts? Money loaned. An amount due to me or us, yes. Money coming in. What you can spend without having to pay up front. Income, money you've received. Yes, an amount due to me or us, yes. Money owed to us. Good, money coming in. Right side of journal entry, depends on what you're recording, can be income. Very good. So for some of us, I think that there's some financial people on here, which is good because it can help us with some of these definitions. Yeah, liability. All right, so let's go to the next one. What is the definition of depreciation? What depreciates? Good job. Loss of value. Value is lost over time. Losing value. Very good. Loss of value, when something loses value. Loss of value of capital assets over time. Bit of a distinction there. Declining value in assets. Something that loses value over time. Decrease of fair value. Very good, yeah. All right. Good, you're close on that one. Very good. So we're almost there. A few others. What is the definition of amortization? So some of those are connected to this that you just wrote up. It's okay if you just put stumped, not sure. A period of time. Yeah, something's amortized over a period of time. Spreading payments out over time. Expensing the cost of an asset of time. That owed over a period of time. Yeah. So one of the things that you'll notice is that some of these, and Carrie will show us some of the balance sheet and income statement in a moment, but it helps to know what these terms mean so that when you're reading these two very high level but important documents in any organization, you have an understanding of amortization, depreciation, balance sheet, income statement, and so forth. Okay. So let's go with definition of ROI. And what does ROI stand for? What does it mean? Very good. Return on investment. Yeah. Release of information. Good for you. Yeah, return on investment. So a little further, what does return on investment mean? Investment, like that. How much gained versus invested? Yeah. Yeah. So again, these are helpful. As you'll see today, we're going to use some of these terminologies as we go through, and they're helpful because if ever or if now you're being asked to write budgets, you might be able to come up with budgets. You might be able to provide some of the ratios that help people understand the value and the effectiveness of the use of money in some of these pieces. Yes, value you're receiving versus the amount you've invested in the activity, the benefit of your investment, what you get back from what you put in. Yeah, very good. So let's do this one. What is the definition? Last one. What is the definition of quick ratio? Yeah, unsure, no idea. Yeah. Why do I need to know this? Current assets over current liabilities. Close. Yeah. Capacity to pay current liabilities. Income to cost. Others? Lots of terminology. Level of liquidity. Yeah, that's it. How quick can you get cash? Yes. Over to you, money people. Awesome. Yep, and that's certainly sometimes what happens is you realize, okay, I need someone to help with all this, and that's good information, and the finance team or the finance person can always, at your organization, can help you out. Liquidity, that's exactly it. Short-term liquidity. Okay, so just helpful for us to think about terminology. When, as I mentioned, sometimes this can be a little bit intimidating. Our hope today is to give you some tools to help make sense of some of this information. So I'll ask you to kind of get an X out or minimize the polls everywhere and come back to the screen that has the slides. Hopefully you can see that. So you're looking for your GoToWebinar icon, so you can go back on. And so here's some of the definitions, working definitions. They'll be in your slides. Income statement, a listing of all revenue and all expenses from a time period. So you've got that. I think some of you got that. Usually monthly, quarterly, or annually. That can be compared to budget and also previous years in the same time period. So this is really common, your income statement. It's something that's presented regularly to boards, for example, to leadership, and it gives you an idea of where you are in terms of revenue and expenses for a specific time period. A balance sheet is a listing of all your assets, so what you own, and your liabilities, what you owe. And these two items must equal each other at the end. And so, again, someone had that good definition of that. So one of them tells you about how you're doing revenue and expenses, and the other one, in addition to that, adds the aspect of assets and liabilities that you have. Debit is something subtracted from an account, either decreasing revenue or increasing expenses. And credit is something added to an account, either increasing revenue or decreasing expenses. So helpful to know what's debit, what's credit. And depreciation, many of you had this, reducing the value of an intangible asset over its useful life, like website development. So you might be able to have that cost over time, over the lifetime of that intangible asset covered in your statements. And then amortization is reducing the value of a tangible asset over its useful life. And that could be like your computers or equipment. And then ROI, many of you had this return on investment. We'll talk about this today. How profitable is an investment? And sometimes a way to compare alternatives. So if you're trying to figure out which way you should go, the ROI gives you an idea of which is better. And I know we're talking financials, and there's of course way more to the work that we do that's mission driven. So today we're just taking that sliver of finances to look at it from that angle. We know that there's way more angles to the work that you do. And the quick ratio is how much of your short-term debt could be covered with cash you can get your hands on quickly. So it's about liquidity. So we think that this is helpful for you to have a working definitions of some of these financial terms. And on that note, I will turn it over to Carrie to continue. You good, Carrie?
Yes, thanks very much, Maria. I'm going to turn my camera on, but I also think I may be having a little bit of challenge. So if the audio isn't keeping up with the video, let me know and I will turn the camera off. So thanks for that introduction, Maria. As you said, it's important to have an understanding of what some of these terms mean if you're going to be looking at financial statements or responsible for budgeting, either on an operational level or on a program or project level. Some of the language does change a little bit over time, or there's multiple terms that mean very similar things, just like there is in many professions. So we'll try to give you a sense too of where there might be more than one term for the same thing. And again, recognizing that this really is to start to give you, for those of you who are, again, new and emerging into leadership and management positions and might not have come across financial statements in your organization before, to start to give you an idea of some of the basic things to look at and look for. So we will start by looking at, again, some of the terminology that Maria shared with us, which is two of the basic organizational financial statements. If you look at an audit, there's more than this, but we really, again, want to sort of just start somewhere and start to develop a comfort level. And in particular, some people aren't comfortable with numbers at all. Sort of that yikes response that we saw. Some people have a comfort level to a certain dollar value, and then the numbers get very big and scary. And something to think about that is the principles are the same. So I've started with some really basic statements to give you a sense of the principles. So you'll see the income statement there, which Maria defined. Sometimes that is also called a statement of operating expenses. There's a couple of different terms, but really what you're going to see there are your revenues, so what you received in funding, in cash, your expenses, which is what you spent, and then the bottom line is a net income, which could be a positive or could be a negative. Each of those will have multiple categories within it. So depending on what you're doing with those statements, you may be looking at the categories. If you're trying to manage a departmental budget, you want to see each of the expense lines, but at the very basic level, that's what you're looking at, revenues and expenses to come up with net income. And then over to the right to your balance sheet. So again, as per our definitions, your assets are what you own, O-W-N, and your liabilities are what you owe, O-W-E. But recognize that your liabilities can be things that you owe to yourself. So an example here, how your income statement affects your balance sheet is you see that net income number coming over. And in some cases, it's called retained earnings. Most cases, it's called retained earnings. If it's something that you get to keep, if you're under budget and you get to keep that money year over year, then it sits there as retained earnings. You owe it to yourself. It's money that you have that you yourself can spend. Or it may be that you owe it back to the Ministry of Health or some other ministry if you're not allowed to keep anything, any net income that you have, so you owe it to them. So again, top section, it's your cash, it's your investments. It's if you have money coming into you that you haven't received yet, but you know it's coming. It's your capital assets, buildings and equipment. And then your liabilities, accounts payable, or the money that you owe to vendors you haven't paid yet. Again, your retained earnings you may owe to yourself or someone else. The money that you have invested in capital assets. That money is owed to yourself. If you dispose of the capital asset, you'll get that money back. And you may have unrestricted funds. If, again, you do fundraising, you have funds sitting somewhere that you're not using, but you will eventually use them. They are owed to you. And Marie, if you can just click and let the next picture drop in. The picture on the left, again, just drives home that idea of retained earnings, because it can be very important depending on the organization that you're in, whether or not you get to keep and invest it and whether or not it has to be returned to the funder. So it could be either of those. There may be other situations as well, but those are the basic situations to look for. So just to get a little bit more in depth into income statements, or again, statements of organization, it's telling you your revenue minus your expenses. So you either have a net profit or a net loss. Quite often we use these throughout the year as well. So you'll see it in your audited statement as sort of a year-end snapshot. But hopefully people who are managing departments, managing the organization, get it regularly, perhaps monthly, so that you can compare it, what you're actually doing, to what you intended to do in your budget. So you look at an expense line, you look at your supplies line, for example, you budgeted $20,000 for the first 2 months for supplies, and you spend $15,000. So you know you're $5,000 to the good. There are financial statements versus management statements. And again, I'm not going to go into those in great detail, but recognizing that sometimes your audited statements look a bit different than what you see month over month, because what you see month over month is intended to help you manage the organization. The financial statements really bring in all of those accounting principles and all of the rules that need to be followed to have an appropriate audit. You can also look at them to compare periods of time. So sometimes you will see a statement for the month that says your revenue and expenses that compares it to the same month as last year. So if you did the same activity as last year, are your revenues different? Are your expenses different? And thinking about why that might be. And that's really the goal of these statements when you see them monthly or quarterly, is to understand why these things might have happened. Why might we be over in one area or under in another? And again, they are activity based. So generally what you do during the year impacts both your revenue, both your expenses. You will see often one of the reasons that something is up or down is because you've changed the activity from what you planned. We'll move on and talk a little bit more about balance sheets. And often when we talk about balance sheets, we look at a tool that allows you to balance two things on either side. And I just kind of like this picture because sometimes that's what a balance sheet feels like, a little bit more than something so staid. And your balance sheet, this is the exact same one that we looked at above. And this is where I want to bring in the concept of your quick ratio, which can also be called an asset test ratio. So again, there can be different names, and there are slightly different ratios for different things as well. So sometimes it's a current ratio, which is slightly different. But as somebody, well, a number of people mentioned in the poll, it's really about your ability to pay your current debts with your easily accessed cash. So your current assets over your current liabilities. If the number that you get is 1, that's really the ideal number, or something higher than 1 is okay too. You don't necessarily want it too high, because if you have too much money sitting in current liabilities, you maybe should be investing them in long term where you get better interest rate. Something less than 1 is not ideal. So in this case, we would look at our current assets as our cash and short-term investments. Those are things we can turn into money very quickly. Our accounts receivable hopefully turn into money very quickly. So in some cases you might want to include those, but you also may have people who aren't paying on time, that it's going to take a little bit longer to get the money. You can't guarantee that money's available to you. And your capital assets, you can't turn into cash quickly. So in this case, I looked at cash and short-term investments. And then I looked at your accounts payable. So you probably need, those are things you need to be paying off monthly. And I assumed that you owed $5,000 back to the Ministry of Health, and they could ask for it at any time. So what you owe in a very sort of, that could be called on in a quick fashion, is $25,000, which gives you a very healthy ratio. So for every dollar you owe someone else in the short term, you have $1.60 available to pay it off, which is a healthy position for sure. a brief, very, very brief overview of audited financial statements, again, just to get you started thinking about looking at them and the kinds of things you might look for. There are lots of finances in them, and there are lots of language and narrative in audited financial statements. The first thing that you really would look for, and it's generally on the very first page, is an audit opinion. And essentially that audit opinion in most organizations, what you're hoping for is an unqualified audit opinion, or that the auditors say the financial statements present fairly in all material respects the financial position of the organization. They'll also comment that the evidence that they have is sufficient and appropriate. You may have exceptions to an unqualified audit opinion, or it may actually say a qualified opinion. There are some examples. Often an exception or a qualified opinion is considered not a good sign. There's something in the organization that means the evidence isn't sufficient, the evidence isn't appropriate, the financial statements don't show what they should. One case that every organization who does fundraising with the general public, fundraising with the general public, as opposed to receiving only government funding, they will always have a qualified opinion. Within the accounting world, it is generally accepted that when you do public fundraising, it is impossible to know for sure that all of the evidence is there. It's entirely possible that somebody accepted cash donations and they might not have been receipted, but there's no way for the auditors to know that. So they would always issue a qualified opinion related to that, which isn't a bad thing at all. Sometimes qualified opinions are, sometimes they aren't. And if you look at your audited statements and look for that opinion, you can see the way that they write it to make it clear that it's not a bad thing. It's just the way that it is in fundraising organizations. You'll also see narrative on the responsibility of management to those statements and the responsibility of the auditors. That's fairly common. And then you'll see your financial statements, and there's going to be notes in almost every audited financial statements that provide further explanation for any particular line. So we're going to just quickly take a look at the financial statements for the Southwest LHIN, and in particular their statement of operations, as I mentioned, similar to their income statement. So you can see here some pretty big numbers. We're talking about $2.2 billion. And I'm going to pause for a second and ask you to do a poll on, is there anything in this financial statement, just having a quick look at it, regardless of how much you know about finances, anything here that kind of makes you tilt your head and go, I wonder what that number is about, or that number I think might be telling me something. So just click somewhere that you sort of see something you think, boy, I'd want further information. If I was a new leader in this organization, I'd want further information about this because it doesn't make a whole lot of sense to me. And we'll give you a moment.
So you'll just need to go back to your link polls handout and click on the link, and then you'll be able to get there. Okay.
Thanks, Maria. There we go. So we've got a few different things coming up that people would want to know more about. I think some of these things, a really good example is $9 million on supplies and sundry. Seems like an awfully big number to just be sort of categorized in that fashion. One thing you'll find with audited financial statements related to that, and maybe some of the other things that people are clicking on from that perspective, is often the numbers get really summarized so that they can make it into a sheet. So if you looked at the statement of operations that the LHIN uses as a management statement all the time, they'll have many, many more categories than this. And then when it gets to the financial statement that you see in an audit, there's lots of things that get rolled up. I'll quickly speak to a couple of other things. I might not be 100% sure of why some things have been clicked on, but some things that certainly I noticed and that I wanted to mention. You can see running down almost the middle of the screen, there's a column called notes. So note 13 is actually going to tell you more about Ministry of Health funding and transfer payments. Note 13 is also going to tell you more about the transfer payments to health service providers. There's a couple of other notes that are going to give you some more information. I want to go down to the excess of expenses over revenue as well, because what I see here is an organization that has gone over budget every year. Now, not by very much. When you think about the size of the budget, it's a fairly small number. But how, if I were a leader, I would want to know, how does this organization cover that? Do they have reserves? Do they have funding somewhere else they can use to cover it? And if you know a lot about sort of the LIN and how that works, they actually aren't allowed to keep if they have extra money. So how would they have any money to cover that, is a question that I would ask. And then again, I know there's questions here about amortization of deferred capital contributions and amortization down in the expense line as well. Again, amortization is a really tricky piece to think about. It does show up in your revenue and in your expenses. So often it shows up in your revenue from the perspective that if you have a building that you're amortizing over time, you're sort of writing off its value over time, which you see in the expenses. And some of these contributions may also be increasing, or some of these capital things that you own may be increasing because the value of them is going up over time. So amortization is something that you don't often see in your regular management statements. It really is a piece that comes in the financial statements, and that the accountants really do spend a fair bit of time working out and making sure that they've got correct for the organization. But the one thing I will note before we move on to the next slide is you can see it balances. There's a note to it, but also it balances. So it really washes out across your financial statement most of the time. It should wash out across your financial statement, but it has to be there for accounting reasons.
So Carrie,
with that,
there's two questions that I think you could probably answer quickly. One is from Pam, who's asking about if you could just talk a little bit about unrestricted funds. I'll go back to that slide. And Janice also has a question about, so if they've got money to cover the, I'm assuming she means the expenses, why isn't it listed? And so that goes to the assets and revenues pieces. But if you want to speak to those, and I'll ask people to go back to the GoToWebinar icon and get out of the polls, and I'll have you just respond, if that's okay, to those questions.
Okay, and I'm sorry, can you repeat the first question?
Yeah, the first one's just, can you just talk about what unrestricted funds are? I can, go ahead.
Absolutely, thank you. So yes, unrestricted funds, you will often see these again in organizations that do fundraising. So if you, or organizations that have a retained earnings that they're allowed to keep over time. So it's really where you've taken money and you've set it aside somewhere. So it may be in a foundation that you own. It may be in your own accounts in your fundraising. And there's the reason it's called unrestricted funds is because there are also restricted funds. So you may have received donations from people who are for a specific purpose. I only want these, or you've run a fundraising event that's for a specific purpose. You've said that your fundraising event, all of the money is going to go into launching a new program. Therefore, those funds are held in a fund called a restricted fund. You cannot use it for anything other than what you said you were going to use it for, without jeopardizing actually your charitable status. Unrestricted funds are funds that you have just received. So often in organizations, if they have a program, an in memoriam program, where they get donations in recognition of people who have passed away, those are often unrestricted funds. The person who sent them in didn't say you have to use it for this, that, or the other. It's sitting there for the organization to use however they want, so it's unrestricted.
And the second question was related to, why don't they just say where they're going to cover this from?
Oh, the excess of revenue over expenses, because you wouldn't necessarily say that in your statement of operations. That really, as the earlier slide that had the income statement in the balance sheet shows, that actually goes over into another, goes over into your balance sheet. And in particular, it depends on the organization. So again, the LIN may actually not know at this point in time where that money is going to come from, how they're going to cover it, but you'll see that when you look at their balance sheet. Have they covered it, or are they carrying it over until they find funding to cover it?
Thank you.
So with that, I will hand the presentation back over to Maria. Thank you.
Thank you. Thanks, Carrie. So balance sheets and income statements are sometimes hard, Janice, even for the question that you asked. It's like, okay, well, it's there, but it's not. So what does that mean? So being able to read both of those pieces together helps kind of put the puzzle together. What we thought we would do is start also or provide a tool for you to talk about the basics of project budgeting. So for those of you who are new or emerging leaders, you might be thinking, wow, that's really high level. I need to know all that stuff. But what about when I'm asked to prepare a budget for a program that I'm running or a project? So for example, something that may have landed on your desk might be, well, you're in charge of the AGM this year. We want you to put a budget together. Or you're in charge of summer this year. Can you put a budget together? Or a new program that we're piloting? Put a budget together for that. And that's kind of the foundation of what we're going to talk about now, then would feed into the larger organizational budgets. So some key things to think about in terms of project budgeting. So it's not so much about a standing program, but a project that you've been given to budget on. The first thing that we want to talk a little bit about is the importance of understanding what financial assumptions you're making. And so you want to ask questions about, you know, what is it that I'm supposed to be counting as an expense? Where are my revenue streams coming from? What are some of the fixed expenses? What are variable expenses? And do I count in-kind contributions in any way? Because when you are a not-for-profit, in-kind contributions actually play a significant role in us being able to run some of our programs. Sometimes though, if we don't count for them, they give a distorted picture of what it actually costs to run a program. So we want to be able to account for them, but you want to know how it is that you're supposed to do that. So it's helpful to be able to articulate and confirm or test the assumptions ahead of presenting the full budget so that you have an understanding of how that comes together. So with that in mind, what I'd like to do is just share with you one financial tool. You may have one already that works for you. This is just one that might be helpful for you, and it will be available. And it's actually, I think Kathleen's already posted it for you. So what you'll see here at the bottom, it's an Excel spreadsheet. There's the assumptions tab, there's a project budget, and then I provided an example that I'll walk us through in a moment. So the assumption is where you start listing all of those things that I just talked about. What you want to know, for example, is so consider what financial assumptions you're making or are expected of you before you even start creating a budget. So the overall financial expectation is, are you expecting a return on investment of a certain level? Are you supposed to be breaking even, for example, or do you have a government grant for it and you know that it's okay because the government grant is going to capture most of it? Are you supposed to be bringing in revenue? Is it a fundraiser? What is the expectation there? Where are you capturing the non-financial impacts of the project? Because again, we have to always remember that in any not-for-profit, you're either running a double or triple bottom line. The one aspect of it, of course, is your clients, and it's about the mission of your organization. And again, today we're just talking about the financial. But when we talk about it from this perspective, I know some people feel like it's a very cold calculation, and we always want to remember that there's always another side to it. Today we're talking the financial. So you want to list that. So you want to be able to ask people who have given you this assignment that kind of question. What's the expectation of this project financially? You would write that. What are the overall financial expectations? You want to then ask, what are the revenue streams that contribute to this project? So did you have a grant? Are you going to be able to use some fundraised dollars for it? Is it coming out of the regular organizational funding contracts that you have? Am I expected to charge for this? What are the revenue streams that are important for you to know? Then it's important for us to make a distinction between fixed expenses and variable expenses. So fixed expenses are those expenses you'll have no matter how many people participate. And you need to also know what you're expected to account for. And I'll give you an example in a moment. And then variable expenses are those things that change depending on the number of people that attend. So for example, you're not going to need as many t-shirts or as many lunches. It just depends on how many people come and are the creative ways to bring those costs down. And then of course, in-kind contributions, as I mentioned, are those types of things that volunteers bring, that a partner might bring for you, that you want to account for in some way so that you get a sense of the true cost of running this event. This is really helpful because sometimes we run events and it's really we think it's not costing us money until we actually put all, for example, the people power that went into the event. That really takes us away from being able to do something else. So when we account for the whole thing, it allows us again to have a bigger picture and be able to understand what is happening. So this is the project budget template that you will receive. And I'm going to explain how it works by giving you an example. Okay, but you can fill it out as you need, and it will be a part of your assignment if you're doing the certificate portion. So I want to highlight a few things here and then go through the example. First, the revenue. So you notice here we want to know, is there a fee for service? Is there an event fee? What are the grants or government funding, donations and fundraise, or other revenue? Like, am I going to be able to rent things? Like if for example, you have booths that you're going to be able to have and you're going to be charging for those, that's rental space, or partners contributions that you want to account for. And then you want to total your revenue. And then in terms of expenses, you want to think fully about this. So what am I supposed to account for paid staff? And how am I going to account for that? So you want to count number of hours, average wage in kind or actual. For each of these different people, you'll see I put there an example of an average wage. That may be low or high, it's just an example. Volunteers pay a huge part of what you do. What wage am I going to account for them at a minimum of, for example, living wage? Students, are we going to account for them? Peers, people with lived experience, we're becoming more and more realistic with the fact that we should be paying our peers who are involved. What will you be paying them at? Is there training that's required? Travel, parking, other miscellaneous like child minding that you have to keep in mind. And then this is our HR, part of fixed. And then you have your variable costs that you want to think about. Well, how much am I going to need bus fare, swag, so t-shirts, whatever it might be, participant materials, food and beverage. Those are your variable costs because they will go up and down based on the number of people that are coming. And then your actual or fixed expenses, which are related to program costs, advertising, equipment, administration, etc. So at the bottom, you'll see that it totals your expenses. You'll see your net. So am I making money or am I not? And then we have quick ratios. I should say ratio. Cost per participant. We should be able to figure out what is this actually costing, which is total expenses divided by the number of participants, just so we have a sense of that. And then your ROI, which is your return on investment. And really, you should be looking at this as point better than -1, but this is just a template. Return on investment is current investment minus current expenses divided by current expenses. And that will give you a decimal, which you multiply by 100, will give you a percentage of your return on investment. So let me go through an example. I thought maybe the example might give you a way for you to understand some of these key pieces. So one of the things that the template does is it helps you understand number of participants, what you're going to more or less charge for the event. And part budgeting is understanding everything, which will then help me understand what it is if I need to charge what I want to charge for the event. So for example, if you change the amount, it will change, of course, how much it is per here. So if I change that to $15, then it's going to change it here. Your government grants, all of these things, the foundation, if you're having one. Note how this is actual and this is in kind. And we want to keep those separate in case your leader just wants to know what your actual costs are. But if they also want to add your in-kind costs, we have them side by side so that you're able to give the full understanding of what this is, okay? And so we want to, the other thing to note here is that if you're accounting For expenses in your volunteers as their contribution, we also have to then account them for the revenue so that it balances out in terms of their contributions. So we have a big question that you'll need to ask is, do I account for my time or any other staff time? Sometimes people will say, no, don't account for it. And then you would keep that blank or account for it as an in-kind, which you can then do as well. Again, peers, I would count in. That's kind of the movement we're moving toward, which is very good. And then, of course, all of the other things. I wanted to highlight those key pieces that you'll need to keep an eye on as to whether you count them as actual or in kind, and how you would do some of these calculations so that you have a true budget of what a certain program costs. So that at the end, if we go through, again, just giving you examples, you'll note here that there's a note element to this, which is where you can put your notes so that you know exactly why you might not be asking for marketing materials, because you're assuming that there's going to be a social media strategy, for example, and so on and so forth. At the end, you will see that you'll have your total expenses, both for actual and in kind, and then you'll be able to understand your net. This number helps you understand what it is that you have to charge, so that if you have to break even for whatever reason, you know that you might need to increase or decrease the amount that you're charging. And of course, how many people you might want to run to your event. If this isn't a factor, you're not going to be charging for the event, then it will tell you how much money you need to fundraise in order to bring that in, or bring from other sources. And finally, participant, which is very helpful for you to understand what it's costing the organization. Not that you're going to do anything different. This might be exactly where your mission is driving you to, but helpful particularly if you're trying to compare whether you should run one program or another. And of course, compare that to the benefit to the participant. And then your return on investment, again, tells you how beneficial and efficient this is from a financial perspective. The formula is there so that it actually calculates it for you as you go forward. So again, we thought that this might be a helpful starting point for those of you who may be budgeting on a project basis, but also for you to be able to understand in not-for-profits the distinction between actual and in-kind, and the distinction between variable and fixed expenses. So I think that's my summary sheet. Remember, two quick ratios that we thought might be helpful for you to have an understanding of is cost per participant and then return on investment, so that you're able to speak just from a financial picture on projects, and so that people understand what they're costing the organization. So with that, I'm going to turn it back to Carrie to finish some other thoughts on the finances.
Thanks so much, Maria. And as we're moving to the next slide, I actually popped into the Lynn financial statements again to have a look at their balance sheet. And you can in fact see on their balance sheet exactly where that negative $90,000, they actually have a line item that started out the year at negative 640 and then ended the year at negative 732. So you can see where they've been accumulating that over time. So for those of you who might be interested in browsing those, if you're crazy like me and get interested in browsing financial statements, you actually can see where that carries through. So looking at our finance and operations now. So we look at the big picture as far as your organizational financial statements. We've looked at budgeting for a project, and want to make sure that we also talk a little bit about managing the budget in a department or a team, which can be very similar to a project budget. Many of the things that Maria talked about are the things that you need to do. So you're actually not going to be looking at any more numbers. We're going to just be talking about some concepts. The first one, we want to talk about budgeting, planning, and forecasting. So those terms do mean three different things, but often we use them interchangeably, and that can cause a little bit of confusion sometimes. So your planning is planning your annual activity. And ideally, those are activities that move you towards your strategic goals. And your budget is the detailed expectation of your revenues expenses based on your activity plan. So your activity plan should come first. You should be creating a budget based on that. Now, sometimes our budgets tend to be carryover budgets, or we create them based on history. And sometimes we're starting budgets from scratch, particularly if we find that they're not serving us well and we need to realign things to reflect reality better. But hopefully what you're doing when you're budgeting is reflecting the reality of your plan. And then forecasting, again, that's where we use historical data and try to predict our outcomes looking forward so that we have a sense of what our budget and our actuals are going to be going forward. When you're managing a department budget, therefore, there's a few things to think about. One of them is, again, what is the plan behind the budget? How was it created? So how was this budget created? Was it just a carryover? And if it was, then there's things, you know, that I can expect, challenges from last year's budget that I can expect to see again. Did we start something from scratch, which means that if I made any errors in assumptions, I should watch out for those. You want to think about what are the rules? What is your authority? What are your limitations? So if you are managing a budget, is there a certain amount that you're allowed to go over in your expenses as long as you balance the whole thing? Or do you have to ask permission to go over in certain lines? So back to some of the conversations we've had before about your limitations, your span of authority, your scope of authority related to your budget is good to know, just as it is in HR and that kind of thing. And you really want to pay attention to your monthly financial reports. If you're getting them, hopefully you're getting them monthly. If you're managing a departmental budget, that it is, when it comes in, you're looking at your comparison of actual to budget. Where have we gone over? Where have we gone under? Thinking about the activity, what happened that was different from what I planned for? Comparison of this year to last year. And then you're going to come up with some commentary. You know, yes, we've overspent on this line item this year, but we planned a lot less activity. And we haven't been able to, you know, keep up with the activity this year. Activity is much more than last year. Activity is much less than last year. That's how you learn to understand what's happening in your finances, is comparing it to your plan, comparing it to the actuals from previous years and the plan from previous years, and also thinking about time of year. There are certain organizations that, again, certain times of year you have increased activity. If your budget isn't spread out properly across that, then it might look like you're over or under budget. Going to move to slide 20, and Maria, I'm seeing slide 18. Yeah, so I got through 19. If we can move to 20, it may be just a delay for my computer. So we're going to talk about trade-offs and consequences. And the idea of unintended consequences. I actually put a resource for you at the bottom. It's a very short article. It's a very easy read, and it's a great, to me anyways, it's a great, just quick way to get your head a little bit around unintended consequences and where they can come from and what they can do. So one type of unintended consequence is if people aren't going to behave the way you expect them to behave when you make the change. So you think if you do X, people are going to do Y. And in fact, they look at what you changed and they say, boy, I'm going to go do C because that works better for me. Think about if you're making a change, or you just passing costs on to another department or organization. So I have a little picture of a Rube Goldberg machine here. And my example from this is, if you have one department responsible for the boxing glove and the bowling ball, and I think we're way over budget on boxing gloves and bowling balls, and you know, we could change that to an oven mitt and a volleyball without impacting our work at all. But what they haven't thought of is that a volleyball isn't actually going to hit the bowling pin hard enough to make it fall off the edge, and all of a sudden the rest of the system doesn't work. So it's really important when you're changing things in order to save costs or increase revenue in your department that you're not either impacting activity or impacting costs. Now all of a sudden they have to find something else, and it costs twice as much as your bowling balls did. So the integration within your organization, recognizing again that your money is just one resource to help you accomplish your mission, and you need to think about it from the perspective of, are the changes that I'm making because of finances, how are they impacting our entire ability to meet our mission? So again, you can see the other examples there. Also think about short-term versus long-term. Am I saving money in the short term that's going to, or sorry, I guess my first example, are we spending money now that's going to save money in the future? So you've got a good return on investment potentially there. Or are we saving money, you know, or being a bit short-sighted, saving money now that's going to cost us money in the future? Those are some of the things to think about. And my last slide on this is some rules of thumb as you're thinking about budgeting. So as we talked about in finance, and Maria's mentioned already, your finance department is your friend. And in particularly when you're budgeting, they're going to help you. They probably have some rules of thumb for your organization. So I've provided some examples of rules of thumb that I've learned over the years, but there may be something more accurate for your organization. So if you're doing, again, either a project budget, a new program, or just revising your current program budget, think about if you're adding a person to a shift. Obviously, if it's a full-time 9 to 5, Monday to Friday, it's 1.0 FTE or full-time equivalent. If you need to cover a shift 24/7, your starting point is actually 4.2 FTEs. So adding a shift onto a 24/7 operation, you start, see, that's 4.2 FTEs worth of people. And then if you replace people, so you may be adding somebody into a position that they're not replaced if they're on vacation or if they're sick, then fine, you're still at 1 FTE. If they are replaced when they're sick or on vacation, then you need to increase by approximately 10% the number of staff you're putting in. Same thing with your 24/7. Your benefits for any organization can be somewhere between 15 and 25%. Again, your finance department will absolutely be able to tell you what that number is for your organization, which can help you create and put those numbers in that template that Maria shared with you. Sorry, there are a couple of other things that I've got here. I won't go through in detail. But again, in your organization, they may be able to say every time you add a case manager, we know that it's going to cost this much in supplies, that kind of thing. Make sure you're thinking about your fixed costs, furniture, computers. And again, as I mentioned, your unintended consequences. Have conversations with other departments to understand if you're impacting them at the same time, so that you can really think about what needs to be done in the future. If what you're doing, you need to work with them a little bit differently in order to implement what you're trying to implement in your budget. And on that very quick note, I will ask Maria if she can close the program for us. Thank you.
Thank you. Again, as always, 1 hour, not enough for us to, but hopefully a good summary of some of the things that might be helpful from a financial perspective. So really quickly, for those of you who are doing the certificate, these are the instructions. We would like you to review the annual financial statements. So those are the audited financial statements. Focus on the income statements that help you understand the organization. What do you see in those financial statements that help you to understand the organization better? So think about some of the things that Carrie talked about, and what is a project or change that you would like to see your organization take on, and using the project financial tool, complete a financial analysis of the project. Use estimates and the rules of thumbs for numbers if you need it, and it's more about practicing than it is about getting it right, just so that you can use the tool. On that note, the only other thing that we would say is we have had the request of doing the series again next year for other people who might be interested. You'll be receiving the thank you at the end of the webinar, at the end of this session. If you don't mind just taking a moment to let us know whether or not you think it would be valuable to run the certificate series again, we'd appreciate that. And the final piece is that the HR summary that you all contributed to is also posted on the site. So thank you again, everybody, for your time today, and we will see you next month for our final session. Thanks very much. Take care. Bye-bye.